Good afternoon, everybody. My name's Hector McNeil. I'm the co-CEO of HANetf, and I'm very happy to welcome Oliver Smith here from Sandaire, who's kindly agreed to speak with us today. Good afternoon, Oliver.
Hi, Hector. Thanks very much for having me today.
No problem. So today we want to just have a very practical discussion around how very experienced investor is using ETFs in their portfolios, and Oliver's kindly agreed to come and cover that. So I've got a broad range of questions which I intend to go through. Now, just some housekeeping matters. There is an ability for people who are dialing into the call to ask questions. And you can add those anytime you want, and I'll pose them to either myself or Oliver as we go on. But feel very free to do that. So obviously the usage of ETFs is rising dramatically globally. Europe went through $1 trillion, Oliver, late last year. And I think you've been at the forefront of using ETFs at your various firms that you've worked for in your career. So I think it'd be really good if you can maybe start with just giving an overview of Sandaire and also your history of involvement with ETFs, if that's possible.
Yeah, sure, of course. So I definitely wouldn't call myself one of the pioneers of ETFs or ETF trading. I have been investing and using in them for the past 15 years or so. So back in 2007, I joined a firm called Saracen & Partners, where I began working on an emerging market fund of investment trust, which at its peak had about $2 billion under management. Now, due to the relative illiquidity in that space, we moved some of our single country allocations to structured products and swaps, those of course being issued by investment banks with an element of counterparty risk. And back then, ETFs were really still seen as retail products. But by the time I left in 2012, the costs for single country emerging markets were coming down quite rapidly. And their liquidity and their improved transparency meant that they became an increasingly large part of the portfolio. So probably about 10% of the allocation by the time I left. After I left Saracen, I spent time in the CIO office at Julius Baer, where that was effectively constructing multi-asset portfolios, both single stock as well as fund of funds and ETFs. And it was notable actually when I was there, and this probably wasn't unique to Julius Baer, that the ETF portfolios performed best in terms of client outcome. The fund of funds performed second best, and the single stock portfolios, which of course most firms will charge a premium for, they didn't perform as well as those others. And that, I think, just really shows the difficulty of effectively having your own in-house team that is buying single stocks, and also the bravery required to be making allocations to businesses which conventional market wisdom would say is overvalued. And that's particularly been the case for those very strong performing tech stocks over the past decade. So I spent a few years at Julius Baer before moving to IG Group, where I launched something called IG Smart Portfolios, which was a conventional robo-advisor, although that term is not used very much anymore. And that used asset allocation research from BlackRock, where we offered to retail clients 5 risk profiles, offering fractional share trading technology, and all dealing through the RFQ format, or request for quote, which effectively means that brokers are able to compete to give you the best price on each line of stock within your portfolio. And this means that when you do trade, you have pretty tight spreads and low frictional trading costs. And I think this is one of the attractions of ETFs at the moment. So just doing a quick fast forward to more recent times, I joined Sandaire 9 months ago as an investment director. Sandaire is a multi-family office, and we also look after various charity and institutional accounts. We use ETFs at the moment as the backbone of client strategic asset allocations and benchmarks. And this is partly because index licensing costs have risen over the past few years. So it used to be possible, for example, to get to get free to be able to write that you use the MSCI index to base your client portfolio returns on, but now those costs are quite high. And also, I think clients are increasingly aware of ETFs, and they want the transparency of investable benchmarks that they can compare their net of fees performance to. And so, just as market innovation changes over time, clients' demands also change, and now quite a few clients do want 100% passive asset allocation.
Sounds very varied and interesting. I mean, I think what I think interesting about your career, Oliver, is that you've both been on the sort of wealth side as well as the retail side, and I can vouch that the smart portfolios you ran at IG as a client myself, I think they're part of what's missing in the European ETF market. What I call the ecosystem, the solutions. And I think when you can get, almost like a private banking light type solution, for relatively low cost, it is a very democratizing product. So you've got the democratizing nature of the ETF wrapper itself, and then you put those together in a model portfolio. And it's quite a powerful tool, I think, isn't it?
Yeah, it is. I mean, it is. I think the good thing about ETFs is the way you can package them up together ensures that every client, doesn't matter whether they're sovereign wealth fund or someone like me or my mother, we are paying exactly the same for the same underlying portfolio, and that's a great way of democratizing wealth management. So if you approach a firm like iShares, they do not offer kickbacks, so to speak, or fee rebates on any of their ETF products. So you can be certain that when you're buying an ETF, you're being treated in a way that's entirely fair and entirely equitable. And the only difference between, I suppose, the sovereign wealth fund trading and one of us is that your choice of broker is going to determine your frictional trading costs. So I'm personally a huge advocate for ETFs, but they don't work for everyone. And I think one of the challenges that the robo-advisors have faced over the past few years is that while performance has been perfectly good, the investments held within those sort of ETF products haven't necessarily captured the attention of retail investors, and this really is where I believe that thematic investments, etc., can have a much bigger role to play in most advisors' offerings to clients.
Yeah, I think I use similar analogies to that. I say that when we're using our Q8 ETF as an example, I say that it's the first time my mother could buy Q80 equities. She could, she just would have no chance to buy them direct from the local market in any shape or form, and the costs, even if she did do, would be pretty prohibitive. So the market access the ETF gives her is, as you say, incredibly democratic and liberating. But then I also say, it's unlikely my mother can wade through the thousands of ETFs that are available, to put a coherent portfolio together. So she needs that solution overlaying the ETF product, to help meet her investment aims. And I'd say that's where Europe's, somewhat behind the US, not particularly on the provision of product, but actually on the tools available to be able to use the product. Especially as you say around robo advice or model portfolios or ETF strategists. I think we're still in early days with that.
Mm-hmm. Yeah, that's right. And I think one of the things maybe for further mainstream adoption is we still see quite a lot of very interesting ETF products which only have accumulation share classes, and that, if you're from the sort of advice world, is normally a no-no, because it makes it very difficult, or rather it makes it much more complicated when an individual is filing their tax return to not be able to split out their income and their capital gains. So for most ETFs, you actually probably want an income and an accumulation share class, and then that can cover all of the bases for the types of clients that both I work for, and everyone else will see as well.
Yeah, I totally agree. I think, in fact, in a way, that's one way that Europe is a bit more advanced than the US, because in the US, the Vanguard has a patent over share classes, so you can't get any share classes on ETFs in the US, whereas Europe, it's pretty commonplace. But like you say, I think that optionality on accumulation or distribution, is a nice feature. And but as an ETF issuer myself, we're looking at an income product at the moment, and to add another share class is probably going to cost £25,000. So I think we're plumbing to have distribution only at the start. But over time add an accumulation share class to that. Because there's pros and cons to both sides. But generally, we think for an income perspective, it's probably important to have the distributing first and foremost. I mean, from an issuer's perspective, it's you want to accumulate because you keep the assets. But I think the flexibility of the client's important from that perspective.
Yeah, exactly.
So just going on a bit further in terms of your current role, then, Oliver. I mean, how are you using ETFs today in your work? How is that all hanging together at the moment?
Yeah, sure. Well, I mean, in terms of how we look at our client strategic asset allocations, we build those solely using ETFs. So just to give a bit of brief background on how that works, we will essentially construct portfolios by using long-term capital market assumptions for the asset classes, and we will make sure that we use forecasted volatilities in terms of how volatile we think US equities will be over a 10-year period. And then we can use the historic correlations between those asset classes to help devise a strategic asset allocation that can, in theory at least, target a given return for a certain level of risk. So the way I see it is, when I'm looking at a client portfolio, is that our default is a 100% ETF portfolio that is entirely investable, and that if the client believed in their strategic asset allocation, which hopefully they should, given the work we put into it, then they could theoretically just hold that 100% ETF portfolio for the time period in which they wish to be invested. And then the tweaks we make to our asset allocation through tactical asset allocation decisions are going to deviate a little bit from that strategic asset allocation, and then we can add some value as well, hopefully by choosing an interesting range of actively managed funds or sector-specific ETFs to improve upon that return profile over time.
And do you find that you think there's enough ETFs for you to use there currently, or do you think there's some notable absences?
Yeah, that's a good question. It's definitely one of the challenges when building a multi-asset portfolio that you may want to include a number of different asset classes in someone's strategic asset allocation. So in our case, because we're using ETFs, we're looking for something which is still going to be investable. And this means that if you want to have an allocation to private equity, let's say, you may have to make some compromises in terms of the underlying ETF which you use for that client benchmark, essentially. So there is only really one private equity based ETF, and that's an iShares one. And similarly, if you're looking at hedge fund returns, hedge funds have got a very poor track record over the past decade as equity markets have performed very strongly, but we still believe that there is a place in portfolios for lowly correlated strategies. But if you do want to invest in a hedge fund type return through an ETF, then there are very few choices out there, and we use a product which has been issued by UBS, and that's actually traded in Switzerland. So that is something which many people in the UK might not want to invest in themselves. And then just lastly, for property, so bricks and mortar property, you have the option of buying REITs effectively. So the challenge with that is those are all very leveraged. So if you're looking for a more physical property return, then the type of ETF you can use is really narrowed down even more. But there is an iShares Target Real Estate ETF that we have in our client FAAs that deleverages itself by having an allocation to index-linked bonds. So it isn't without its challenges using ETFs, but hopefully where an ETF is seen as slightly suboptimal, we can still asset allocate to that asset class through other means, and that will normally mean through conventional funds.
Yeah, it's interesting. I think with all the furore last year with Woodford, my sort of view is that, over time, all, funds that have a daily liquidity, a real daily liquidity capability will probably be done in the ETF wrapper, but you'll still get the non-daily liquidity like, physical property or private equity or venture capital, where, it's very hard to hedge and have proxy for that. And obviously, with an ETF, you should be able to create and redeem equally, so it shouldn't really have any issues. Because one of the things I thought was quite scandalous about the Woodford affair was, that you've got products called equity income that are holding, stocks that are unlisted and don't pay any income, and this was dressed as a daily liquidity fund, which clearly, when a certain level of redemptions were called upon, it was unable to fulfill its obligations. So I think the rigor of that liquidity screen, is really important in the future for investors. I think.
Yeah.
People understand it.
Yeah, I mean that's something that I tend to agree with, and one of the great attractions I think of ETFs is that pure transparency that you have in terms of the underlying holdings. Now it's very rare, of course, that you go onto the provider's website and look at all the underlying holdings, but you have that implicit guarantee within equities at least that the basket that you own can be have intraday liquidity. Now, it's probably the case that when you move into some of the more specialist parts of the fixed income market, whether that's senior loans, which is just loans issued by banks, and those are traded in the US, that the underlying is not that liquid, but that is where your team's due diligence comes into play, and ultimately, I think for anyone who makes any investment, it's up to you to make that decision about whether the allocation you're making is appropriate for your client or not.
Yeah, no, I think as well as we get more off the sort of what I call the futures equivalents, the FTSE 100s and Eurostoxx 50s, etc. The more you'll be able to do efficient creation redemptions, but the trading aspect to it is less. And I mean the volume trading aspect to it is less.
Exactly.
So if you were just to sort of generally summarize, what are the sort of top 5 ETFs that you're holding now by AUM, and what do you like about them?
Yeah, so in terms of the top 5, I think are similar to quite a few firms in having a reasonably high allocation to the US. The US, of course, makes up, I think as of print today, probably 59% of MSCI ACWI. So we have roughly a third of our allocation there in passive instruments. We have a big position in the Vanguard S&P 500 ETF, which is to me, there are some very close competitors for it, but that is a fantastic product, I believe, for making long-term asset allocations. And it's particularly the case that if you're a tax-paying client, so you may have capital gains to worry about, that you want to have an ETF that's got large enough assets under management for you to be pretty confident that it's going to be there for the next 50 years until you finally retire or need to sell down your assets. So the trading costs for that are just in terms of market spread are just 2 or 3 basis points, and that is very, very cheap. But actually, what's interesting is that compared to an American who'd be trading on the New York Stock Exchange, that's actually very, very expensive. So the most liquid ETFs in the US will have a bid-ask spread of 1/3 of 1 basis point, meaning if you've got $1 million, it'll cost you just $30 roughly to buy and sell it in terms of frictional costs. So, Europe has fallen behind, but that really is just due to the number of exchanges we have and the number of options that people have to trade, and that leads to slightly wider spreads. So anyway, that's one core ETF. We also have an allocation at the moment to SPDR USA Value. Value, as you well know, has been very, very out of fashion for the last decade or so. And actually the number of true value-based active managers as a result has really shrunk. So it's quite difficult to find good value-based managers, and also ones who aren't taking on too much stock-specific risk. So we think a broad-ish based approach that can add value and help to diversify portfolio returns over time. So we have that. The other one I think that's probably worthy of mention is within fixed income, we have an allocation to US TIPS, and that is on a hedge basis, and that's taking the 1 to 10 year TIPS. So for fixed income in general, there are some people who just say that you should always buy an active manager for fixed income. I take a more nuanced view. I think that if you're genuinely looking to add or to differentiate yourself from the benchmark, you either take a credit decision or a duration decision. But if you're buying an active fixed income manager, normally they are sort of targeting parts of the market that are less liquid than those securities held in mainstream ETFs. So if you do just buy active fixed income funds, you're opening yourself up to illiquidity risk. So for me, a blended approach is more attractive. And in terms of this US TIPS product, it is a UBS one because that is the only one out there which targets a 1 to 10 year maturity, and we don't want to take too much duration risk at this time. And then finally, the gold market is one where, of course, there is much more competition now, and you have your own offering, which is very interesting from an ESG and SRI perspective. Being very honest, we don't hold it yet. But I think gold is a fantastic product to hold in an ETF wrapper. You have that physical storage element taken care of. You have generally zero counterparty risk. There should be physical bullion in vaults, and it's a very liquid market, which given the low correlation of gold to other asset classes, means it should be a mainstay in most people's portfolios over time.
Yeah, I think I always say it's the only form of currency that's lasted 10,000 years and still as relevant today as it was then, really. So it's a pretty incredible asset class. I mean, we often get asked questions around the fact there's finite supply and what happens if it all runs out, and all those types of things. And then I find myself having to give basic economics tutorials, on supply and demand. And if there's finite supply and demand goes up, I say, what happens to the price? And it's amazing. People like a lot of the horror stories where they say it's going to run out and there isn't going to be enough and such like. But it's quite an interesting debate from that perspective. I think often and evokes lots of emotions. Just gold. It's an interesting one.
Yeah, it's a very interesting asset, and it's one that I've always personally been relatively skeptical of, because in a way, if you have a long-term allocation to that, you're as a few strategists put it, you're shorting mankind's ingenuity, to generate sort of alpha or added returns from equity growth. But in times such as we are at the moment, where you are potentially going to see a huge increase in the money supply, then, as you say, simple economics should mean that things which are scarcer go up in price. And it's something which people still either like or dislike. But the thing about investing is that when you're building a sensible portfolio, I think you should always hold stuff that you hate, just in case you're wrong.
Well, I mean, if you think about it, when you drive a car, everybody has insurance and airbags, right? So to me, Portfolio is no more different than real life, right? Gold I think is your insurance asset and your airbag, really. For the situations you don't think you're ever going to have, but you've got it there just in case.
Exactly. So it's a sensible allocation. And then I guess in terms of maybe one other ETF which we have at the moment, I probably didn't mention we have an exposure to minimum volatility, which of all of the factors, I think that value growth and minimum volatility are the most interesting of those factors. And this is particularly the case in an ETF format, whereby to have an overweight to the size factor, meaning to small cap, just simply is not feasible within ETFs, because true small cap is too illiquid really to be held. But it's been shown time and time again that allocations to minimum volatility are a genuine way of adding diversification to portfolios. They tend to hold up very, very strongly in market corrections, just as we saw in March. And those I think will have an ongoing place in portfolios, as volatility at the moment is quite high and probably will persist.
Very good. And just on that sort of vein, then, how do you go about choosing your ETFs, and what sort of due diligence process do you go through, both at Sandaire and in the past? What sort of would be your top tips on what you look for an ETF, and the do's and don'ts?
Yeah, sure. I think the first thing is to be absolutely certain of the index your ETF is trying to track. If it's the S&P 500 or the FTSE 100, it's pretty obvious. But if it's a fixed income index, for example, whereby the largest positions could just be the largest debt issuers, which isn't necessarily a place you want to be, then it's always worthwhile to look under the hood and to make sure that you are getting a sensible asset allocation that fits in with the rest of your portfolio. The second thing is we always want to make sure that from a regulatory standpoint we're buying something that we are allowed to do. So this means is it a UCITS vehicle? Does it have UK reporting status? You can fall foul of that if you accidentally, let's just say on your brokerage platform, buy a US ETF, whereby you're taxed at income rather than capital gains, or can be anyway. There's that old thing of making sure that the ETF has a low tracking error. So for the benchmark in general nowadays, you find that the investment houses who are building these ETFs have got very, very low tracking error. But it still can be the case that an ETF might not be able to do its job as well as you would hope. And then I suppose a secondary filter, and this is really looking more at the at the costs of trading ETF. Are you confident that there are enough people making a market in it? And we always say that one of the great advantages of ETFs is that in times of stress, such as in March, you have perhaps a dozen market makers making a price in your ETF versus one potentially very stressed out dealing desk who are just trying to sell allocations within an actively managed fund. But it's still worth checking that when you're buying ETF from particularly one of the smaller providers, that they do have those networks with the market makers. There is stock lending to consider. That's something which I'm personally all for, as long as there's proper safeguards and protections there. And stock lending over time can add quite a lot of value in terms of to enhance your returns. So that probably covers the sort of main aspect of it. But but of course there are more and more things which you can look at. And Hector, you're an expert on this, but you want to be sure on the currency of the ETF and the exchanges traded on. We mentioned already whether it accumulates dividends or just distributes them. And then there's the actual methodology used to construct the ETF, whether that's a replication, optimized, a derivative, stratified sampling, etc. But this would normally come out when you do your tracking error analysis.
And are you agnostic to issuer, or have you got a preference for issuer?
We are agnostic. I mean, it's definitely the case that, you know, once you've done your due diligence on an issuer, you're going to look at them from an operational perspective as well. So therefore, if you've done your due diligence on Vanguard, it's a much quicker process to buy another ETF. But you know, we are completely agnostic, and if we think that an ETF fits in with our asset allocation or targets a part of the market we're trying to get access to, then, you know, we don't mind who the ETF, you know, we don't mind how that ETF is badged and branded. So, you know, often one of the considerations when you're buying an actively managed fund is size, and that's because of the liquid element in there. You mentioned Woodford before, whereby if that fund shrinks in size dramatically, you may be left with some very hard to shift stocks or even some unlisted securities. But if you're just buying an ETF in the market, it doesn't actually matter if it's got a very small market cap to start with.
And on that, do you think? I mean, I often think that the industry, you know, has applied a lot of the classic mutual fund type due diligence process to ETFs, and I think in some ways it prevents them from, you know, rewarding innovation and you know, new strategies coming to market, you know, and you know, by either being obsessed with trading volume or assets under management. I mean, I actually physically banned my sales team from talking about trading volume as liquidity, because I mentioned I'm very, you know, as an ex-market maker, you know, the liquidity on an ETF is really, it's a pass-through vehicle. It's really from the underlying assets, and I always find that trading volume is probably only useful from a perspective that a lot of pairs of eyes have looked at the product, and therefore it's got some you know, herd mentality to it. But essentially, there's very few examples in the world of ETFs where the ETF is actually more liquid than underlying on a constant basis. It can happen at times, but it's not on a constant basis. So really, you know, I often think the market sort of, you know, cuts his nose off spite his face by not rewarding innovation by looking at the smaller funds. So would you take a view if you thought somebody came out with something pretty unique? You know, would you be early to the party, or would you wait until you saw, you know, the fund, you know, in operation a certain time, its growth, or what would you be?
Yeah, I mean, it's, you know, it's a good question. You know, we are a multi-family office, so, you know, the sort of cliche is that we're not going to be the most nimble, but you know, there's still, you know, I personally take the view that, you know, if you really want to invest in something and you've done your due diligence, there's no reason why you shouldn't do it. And anything that you know you're prepared to buy, you've already taken account of the size of the ETF, you know, how long its track record is, etc. And this, I think, is particularly the case going forwards for, say, thematic ETFs, where if you want to target a particular subsector of a market, and to be honest, it doesn't even have to be a subsector of a market, because it's just classifying securities in a different way to the conventional, you know, GICS sectors, GIC sectors. Then that's something which, if you've done your homework, then you can look to do it, look to invest. So, for example, we bought, and I won't say who the provider is, but we bought an ETF about 3 months ago, which I think it probably had £25 million worth of assets under management, which in the conventional, you know, funds world would be too small to consider. But we made an investment. It was, you know, investing in a very liquid market, and we could trade that afternoon with no problem at all.
Yeah, but I think that's it. I mean, most people don't realise that, you know, when the market makers doing creation redemptions, you know, the basket sizes, which is the sort of accumulation of the securities in the shape that the fund manager wants to receive them in, is usually circa around $1 million, and a maximum to 1.5 million. So, you know, the fund, you know, is tracking the market very, very closely with that sort of level of investment. So I totally agree with you that you know, the ETF can be pretty efficient, and the actual reason for that is that, you know, the screen in the ETF index is likely to hold a a minimum liquidity measure for the least liquid stocks in the index. So you know, it used to be a terminology we used in rugby that you're only as good as your slowest man, and the same is true for liquidity. You're only as good as your least liquid stock. So I think that's a really good discipline that ETFs have, and it means that you can efficiently you know, put $500,000 trades on, or $1 million trades on a $1 million fund, and still have it efficient, because that's how they all start and that's how they all grow.
Yeah, no, you know, that is definitely the case, and you know, and of course the market makers now are incredibly sophisticated in terms of how they offer creation and redemption. And you know, but actually, that said, if you are looking to trade ETFs, you know, we did some analysis when I was at IG, and it showed that if you wait till after 8:30 in the UK, you normally find that spreads are a bit tighter. If you're looking to trade, let's say, Latin America or Brazil, you probably want to wait until the Brazilian market is open and then put the trade on. Or you know, if the trade's of particular size, you can maybe target, say, NAV tomorrow. If it's going to be very difficult to hedge the actual ETF, you know, underlying with futures. So there are lots of ways to kind of optimize the way that you trade these two.
Yeah, totally agree. So carrying on the thematic theme, Oliver, what sort of themes are you looking at the moment that are interesting to you, maybe personally and to Sandaire? What is the things you're looking at, and why?
Yeah, so in terms of themes, I think really, you know, the main driver of market returns, or rather of sort of different market returns, has been that kind of growth and value debate. And that feels like it must be approaching its peak at the moment, whereby you've seen the MSCI World Growth outperform its value index cousin by, I think, 27%, I saw earlier, but based on the last year. That's just 1 year rolling. So, you know, that and is probably, I think, going to be the main driver of kind of market returns for the next 5 years, maybe. So to capture that turning point. Now, of course, no one wants to catch a falling knife exactly, but you know, these kind of structural shifts in markets can take place over a certain number of years, and to have been on the wrong side of the value growth trade over the past decade has been very, very painful. And if we get a little pickup in inflation, perhaps you know, some of the sort of poorer, more debt burdened firms within industrials, within financials, etc., go to the wall, then that could see the prospects of, I suppose, supernormal profits emerging in that, you know, in that more traditional value arena. So that's something we're looking at very closely. We're very interested as well in the whole theme about inflation protection going forward. Now, you know, we think certainly this year in the US at least, you will see deflation, probably -2%. But then there's been this extraordinary stimulus, and it just depends whether the velocity of money is going to pick up by enough to really generate sustainable inflation going forwards. But you know, the one thing about buying into any theme is that you want to be there early, because markets, if they do get a sniff of inflation emerging, will start to reprice things rapidly. So that, you know, so precious metals are interesting, perhaps ones with a more industrial component, such as silver, although of course that is a small market, but that could be of interest, and we're thinking about those types of investments. You know, purely from a thematic ETF perspective, there has been huge success in some of those cloud technology ETFs, and I think that's an enduring story that will go on. But I also think that as the economic environment starts to shift and starts to change, we will see more thematic investment sort of opportunities, which I haven't thought of, emerge in the next 18 months or so. And it could be that, you know, early allocations to those opportunities, wherever they are, you know, could prove to be very profitable over the next 5 years.
Very good. And you know, one of the themes I know you and I both have been asked about and talked about recently, and we don't want to give too much airtime because there's a lot of airtime being given to it. But you know, what's your feeling on, you know, is ESG SRI, is it a standalone theme, or will you just find it being embedded in all investment themes over the sort of medium to long term? What's your sort of view on that side of the table?
Well, it seems to me that as long as corporate governance can improve, and as long as I guess the rule of law is applied consistently across firms who are operating in different markets, perhaps with different environmental standards, and if those improve, then ESG and SRI would have done its job in genuinely improving how companies are run, and in terms of the types of emissions and pollution problems which they have at the moment. We do of course have clients who are very interested in ESG and SRI, and I think most people are genuinely concerned about environmental issues, etc., and don't want to be in the worst polluting asset classes. But genuinely, I think the sort of debate should still be had about whether ESG and SRI will outperform conventional market cap index over time, and really the jury, in my view at least, is still out on that, and that's just largely because ESG and SRI ETFs, by their very nature, will tend to be focused more on newer technologies, on less capital intensive industries, and certainly year to date, those less capital intensive balance sheet companies have performed much better. So you could look at firms by their credit rating and see that firms which are AA rated have performed much better than those which are A rated, and consecutively better than those that are BBB rated, etc. So this structural tilt towards technology has definitely helped SRI, but it's not all plain sailing. So the one area that is notable for its underperformance is emerging markets SRI year to date, and that's because China has a much bigger weight in the market cap index and has performed very well.
Excellent. Just a reminder to the audience, anybody's got any questions, feel free to send them through. We can deal with them. And could I also ask people to give feedback on the feedback button on these slides as well? Given that I don't think HANetf defines itself as a thematic provider, Oliver, but obviously so far most of our products have come out into that space. I just wanted to get your opinion on some of the products that Han is in its offering. I've just put the product list up. I just wondered if there's any of these themes here that stand out to you as being areas you think investors should be excited about and like the look of.
Yeah, sure. I mean, you've definitely been in the right place in terms of targeting those new technologies. So whether that's a cloud technology, your EMQQ product, I know, have performed very strongly year to date, and it seems particularly given the environment we're in at the moment that investors will continue to want to invest in that space. I'm personally, and I've said this to you on another panel, I think the cannabis part of the market is simply too niche and too untested at the moment. I think there are quite a few business models in there which were maybe quite speculative in terms of raising capital from investors, and over time, those will be weeded out. That probably is an area of the market which I think still has to mature. But of course, there is a place for investing in early stage and more speculative parts of the market. So people will do that. But I suppose your standout product in terms of perceived pedigree would have to be the Royal Mint physical gold ETF, which is one which looks very interesting.
Yeah, I would agree. I think it's a long-term game changer, and I think it really does add quite a lot of diversification, because virtually every gold ETF you look at has their gold at either HSBC or JP Morgan in London, and gold books tend to want to be outside the financial system, and I think having the Royal Mint's vault in Cardiff and not part of not a financial institution, and being the oldest company in Britain, over 1,100 years old, I think offers a real level of diversification for people wanting to hold the gold. I think as you mentioned before, the the responsible sourcing element that is 100% backed by the LBMA responsibly sourced bars, is really gives people an opportunity to differentiate between where they're getting their gold from, avoiding conflict zones, questionable working practices, underage, what people would see as underage labour forces, being involved. And then I think also with the Roman having the physical delivery, that you can actually convert your gold ETF into coins and bars, I think is quite exciting as well.
Exactly. Yeah.
One question I did have to ask you is one product I think is a sort of bit of the Cinderella product for us is the innovative technologies. You probably don't know it that well, but where I think this is interesting is it's across sort of 8 mega themes. But I think the interesting thing of it is it's equally weighted. So it equally weights across the mega themes, and then equally weights each stock within each mega theme. So what essentially happens there is that the FANGs, for example, are less than 5% of the allocation in that ETF, and it's pretty much either kept on par with the Nasdaq or outperformed the Nasdaq. What's your sort of view of something like equally weighted for something like that?
It's an interesting question. I mean, I used to actually run an equal country weighted strategy when I was managing emerging market portfolios, and the advantage of it is you get far more diversification and the individual stocks or countries that are lowly correlated. The disadvantage to it is if you get something which continually performs quite poorly, and it just, let's say in the emerging market space, you are allocating to Argentina, then you have that risk of continually kind of rebalancing back into a value trap. Now, it's going to be a little bit different, of course, with with an ETF such as this, because presumably there will be some kind of a market cap filter which you put onto it, some kind of a liquidity filter, etc. So you're not going to be buying something that's fallen 90%, hopefully, and then see it fall 90% again. But that is definitely a risk of equal weighted strategies. And also the other risk potentially is that in areas, in some parts of the market, it's actually very few winners who really drive the market. And when I say that, I'm just thinking of FANG. So there have been numerous tech companies which we now haven't heard of because we've all forgotten about, which have fallen by the wayside, while the gains in the S&P 500 have really been driven by that small cohort of stocks. So I think just as long as there aren't too many holdings within the ETF, then an equal weight approach has merit, and it certainly has merit if you don't know who those future winners are going to be.
Yeah, it's an interesting thing, I think, as well, because I think that, in theory, with the drawdown we've had, it should have some sort of, extra diversification benefits to that. And I think as well, it's what I've noticed with the products is it's done pretty well with the sort of emerging themes that are coming out. Companies like Zoom, etc. That are coming out as real winners. And you get a pickup on those. So I think it's to me, I think it's quite a nice product to have as a sort of if you're going to have a core tech allocation, I'd certainly think of diversified a little bit into that outside of the Nasdaq 100 really. So that was my take on it. But it's an interesting way of looking at the world.
Yeah, exactly. And I think if you're going to launch a new product and differentiate itself from just being the Nasdaq 100, then it's got to be doing something which is significantly different to it. And this type of approach, would lead to a different return profile.
Yeah, I think it's safe to say most passive and active tech funds will be very heavily dominated by the FANGs. So you're quite right. You get something a little bit different with that.
Yeah.
But, I just want to sort of wrap up with a question on that. You're probably probably not with your finger on the pulse on it, but you're probably watching the fact that there does seem to be a big move in the US with the non-transparent active ETFs, and given that ETFs have a big tax advantage in the US over mutual funds, there seems to be a view that given the SEC's taken 10 years to sign these things off, that there will be a massive swell of movement of the active world moving to the ETF market in the US, pretty much as it did in the early days of the index world. You know, that the ETFs won the battle versus, you know, classic index mutual funds because of the tax advantage. And I think I heard a stat the other day that 40% of the active managers in the US have filed for non-transparent active ETFs. So it seems to be they're all voting with their feet as well. Do you think that I mean, I sort of have this view that ETFs are very, very friendly from a consumer perspective. You know, that I always use the example of my son. You know, he's going to want to do everything on his phone. He's going to want Amazon Prime gratification, and he's going to want everything in one place. And, you know, mutual funds just don't do that. You know, it's still the only thing that you can buy that doesn't give you the price the day you buy it or as you buy it. And, you know, you got to fill lots of forms in. And, you know, I know for a fact my son's never going on a checkbook. So, you know, my feeling is, you know, it's not a passive equals ETF. ETF is just a wrapper. It's just a piece of technology. And I do think there has to be a bit of a paradigm shift. But what do you think? Do you think that, you know, the active world, you know, will... And one thing I want to add to this as well is I think one of the things that the Europeans added as well, where you can have a non-listed share class of an ETF. So you can have effectively a mutual fund tagged onto an ETF. I think there could be, you know, you could see quite a bit of traction for this sort of venture in Europe. Maybe not for legacy offerings, but for future offerings. I mean, what's your view on that?
Yeah, it's something which I think has definitely got potential. You know, just as self-driving cars will you know probably hit our roads eventually. I think the non-transparent ETF will also come to Europe at some stage, and it's something which to be honest, I would quite welcome. I think, you know, just as long as, you know, people it's made clear perhaps that it isn't transparent. So it could be called something different. But in general, as you well know, trading products on exchanges, frankly, much easier and subject to fewer execution risk rather than matching trade dates for actively managed funds or even index funds. And some of those might only trade once a week. And any way that you can bring down your execution risk, I think is a positive thing. I think possibly from a business model perspective for actively managed funds, it's going to make things more difficult. And I think one of the reasons it makes it more difficult for them is that there's an awful lot of due diligence that goes into analysing actively managed funds and putting them on the buy list and taking them off the buy list, etc. And it seems to me that the relationship that investors have with ETF providers is far less. I don't want to say cozy, but it's it's something which requires far less face-to-face contact. And if I'm thinking of selling an ETF, I will automatically just sell it straight away. But if I'm thinking of an actively managed fund where you potentially have a relationship with a sales guy and you've been cultivating that relationship for years and you meet them in your office every 6 months, it's a little bit more difficult. So I think it would probably mean the actively managed funds industry that their clients are less sticky, and that's going to be a bad thing for them. But of course, frankly, if that is the move the industry makes, you have to join what everyone else is doing.
Yeah, no, I think that's right, and I think it's bizarre, isn't it? How as an industry, we define or we conflate the wrapper with the investment strategy, and you don't do it with when you talk about Cayman funds or OICs or structured products or whatever. To me, it's just a piece of technology, and if it's better technology, I always use the analogy it's mobile phones versus landlines, radio versus microwave or whatever. It's just an advance on what's available. I think it's inevitable that will see the light of day, and also as you get more ETF only portfolios, people are going to demand all investment strategies to have the best way to diversify. So if there's still areas that active managers feel they can outperform and have track record of doing so, then I think it's inevitable that you'll see them just adding the wrapper to their library, to their arsenal, really.
Yeah, exactly.
So I just wanted to just open it up, see if there's anybody got any questions, or Oliver, have you got anything that you want to add to you don't think we've covered or you think is important, or whatever the story is? We're sort of getting towards the end of the show now.
Yeah, I mean, certainly, from my perspective, it's been a pretty thorough call. But of course, if anyone does have a question from the audience, I'm very happy to answer that as best as I can.
So I've just got the one question so far, and I think it's quite a good one. As usual, what everybody always asks an investment manager: what's the one trade you would make this year? If you were to recommend one trade to your aunt, to your uncle.
The one trade I make this year, well, I think the one way that you can be confident of not losing money in real terms this year is by holding cash. But if I had to choose an actual investment, I think that I personally think gold is an attractive part of the market at the moment, and I'm convinced that as we see more stimulus efforts and more rounds of quantitative easing, that that there will be more participants looking to move into that.
Fantastic. Well, I just want to say thank you, Oliver. I think that's been really insightful, and I think we often get accused in the industry of not doing enough about education and showing people how to use products correctly and thought process. I think you've given some really insightful advice and information and just insight into how you use ETFs and what you think about them. So I'd like to really thank you for that, and I'm sure the audience similarly will be very, very thankful for that. So thanks very much, Oliver, and we'd love to have you on again soon.
Good. Thank you very much, Hector. It's been great to talk.
Thank you very much. And everybody out there, thank you very much for attending today. And, as Oliver rightly said, if anybody's got any questions or needs any follow-up, particularly those who, maybe listen to this at a later date, then feel free to come through to Han and we can pass your questions on to Oliver or deal with them directly. But again, thank you for your time. We have a presentation we're doing tomorrow on EM e-commerce with ETF Strategy. It's a free conference call again, so you can register for that. And we have pretty much one or two of these a week. So please feel free to register for those. And thanks for your time again. And we look forward to having you as investors. Thank you very much.